This is Horizons Middle East and Africa. Our top stories this morning. Asian shares track Wall Street higher, with Japan outperforming as more evidence of a slowing US jobs market boosts the case for a Fed rate cut next week. With Russian President Vladimir Putin set to arrive in India, Prime Minister Modi faces a delicate balancing act between one of the country's most trusted partners and the United States. Plus, Bloomberg learns of discussions taking place for Treasury Secretary Scott Bessent to potentially lead the White House's National Economic Council, should Kevin Hassett become the next Fed chair. It's just gone 9 a.m. across the Emirates, 5 a.m. here in the UK. I'm Tom McKenzie in London. Let's check in on the markets then. Some gains that came through on Wall Street, of course, but it was the Russell 2000 that outperformed the Nasdaq 100 and the S&P 500 by the end of the close, with that index, of course, of smaller caps stateside gaining close to 2%. The ADP jobs data was consequential, of course, the weakest print for the month of November that we've seen since 2023, shedding those jobs in the private sector in the US, and that has increased those bets then on a Fed rate cut next week. Now, Trade is basing in a more than 90% chance that that comes through. S&P munis today currently flat. The picture for European futures is looking brighter, pointing higher by 0.5%. So on track, European stocks for a fourth straight day of gains. Nasdaq 100 futures pointing a little lower by 16 points. Let's flip the board and have a look cross-asset. Check in on the US 10-year then after the move, of course, into Treasuries yesterday on those increased Fed rate bets. 4.08 on the US benchmark today, a move of close to 2 basis points. Euro dollar at 116, a little softer for the euro after some strength yesterday, down 0.1%. Brent in focus, of course, on the geopolitics, and we, of course, look at that meeting between Putin and his Indian counterpart Modi later today. $63 a barrel on Brent, up 0.4% in the session, and copper at fresh record highs, 11,500. Goldman Sachs, though, saying that this strength is unlikely to last. Doesn't match the fundamentals, is the view from Goldman Sachs. Nevertheless, the run-up in copper has been significant, up 0.2% so far in the session. Let's zoom in then on how the markets in Asia are faring. Min Min Low in Hong Kong with a check on the markets, and certainly Japan in focus, Min Min.
Yes, Japan in focus, and just now you mentioned the copper rally as well. We are seeing Asian mining stocks on a tear today, but here I want to show you some of the robotic names in Korea and Japan, because you're seeing double-digit gains, really huge gains here after Politico reported that the White House had issued a report supporting the acceleration of the robotic sector in the US that's helping to lift some of these robotic names in Asia. But you flip the board though, and you would notice that this rally in the robotic sector is not enough to broaden out to the regional benchmarks. You look at the Kospi, the TAIEX, some of these tech-heavy indexes are still in the decline. There continues to be concern around that build-up of an AI bubble. The Nikkei is really the outlier here, up by 1.8%. But there's a lot of things going on in Japan, right? We have the BOJ rate hike expected in December. Traders pricing in an 80% chance now, and that's why we are seeing a rotation into the banking sector. You can see the MSCI finance sector in Japan really gaining over the past month or so, coming at the expense of the MSCI Japan semiconductor sector. And that is what we are watching here. Also, we have the 30-year bond auction in Japan as well, seeing surprisingly strong demand here today.
Min Min Low in Hong Kong, thank you very much indeed. With a check on the Asian markets, of course, the yuan fixing interesting as well. A weaker fix coming through from the PBOC as they try to steer that currency, given the strength that's come through in recent days and weeks. Now, US companies shared payrolls in November by the most since early 2023. ADP research data showing that private sector payrolls decreased by 32,000 last month, adding, of course, to concerns about a more pronounced weakening in that labour market. Joining us now is Pierre Chartres, Fixed Income Investment Director at M&G Investments. Pierre, good morning. Thank you for your time. So, of course, traders now in the swap markets increasing those bets on a Fed rate cut next week, about 90%, a little over that. Do you go with that view? Does the Fed cut in December? And then I guess the question is, how do they frame that cut?
Yeah, good morning. And you're absolutely right. The framing of the rate cut will be maybe the more difficult part, because in a way, the Fed hasn't had kind of all the labor market data and all the inflation data that it would expect on a month-to-month basis because of the U.S. government shutdown. So they have limited data to go by, but probably, if you look at history, they tend to side with the markets. And although it's not a foregone conclusion, as Chairman Powell said at the last meeting. Our view is they're probably still inclined to cut rates. And the big story in the U.S. is, of course, the softening labor market. And we saw that again, and as you just mentioned, with the private payrolls yesterday. And that softening of labor market, which is expected to continue into next year, is probably enough for them to continue to cut rates.
Pierre, we know from history that once the labour market starts to weaken, it can happen quite quickly and often leaves central banks on the back foot. How concerned are you about the US labour market at this point?
It has definitely been normalizing from very tight labor markets, whether it's the amount of jobs per unemployed worker. It's come down from record levels, to more normal ratio. And recently, outside of maybe leisure and healthcare, you have seen job growth that is very slow or even negative. I mean, within the fixed income markets, the great thing about being a fixed income investor is you can adjust the allocation of your portfolio. And as the job market continues to weaken, and right now equity markets, for example, are still seeing that with a positive tone. But if that continues, it could mean that the Fed has to cut interest rates more. And therefore, we still see value in U.S. Treasuries at this rate from a bond perspective.
Where along the curve do you find the most value, Pierre? How much is priced in the front end? Is the long end looking attractive? And is the curve steepener trade still on an opportunity?
Yeah, I mean, in our view, the long end is definitely looking a lot more attractive than it has in the past, right? If you think about 1 or 2 years ago, yield curves were inverted. Investors were not being paid to go longer duration or to extend the maturity of their government bond portfolios. Now we think that picture has changed quite a lot. There's a lot of bad news that's already priced in at the long end. So we have been gradually edging towards longer dated government bonds, very slowly. We're still aware of the fiscal situation, those risk premiums, but you are getting to a point with 30-year Bund yields, for example, now the highest since 2011. Same thing in Japan, where some value is starting to emerge, and you need to cover those underweights at the very least.
Okay, so edging into the long end of the curve. Pierre, what do you make? On the front page of the FT this morning is a warning from bond investors about a Kevin Hassett at the head of the Fed. We don't know if that is the decision yet, but certainly that has been the signals from the White House, and concerns that he would not be immune to pressure from President Trump. How do you share those concerns? So, of course, as bond investors, central bank independence is quite important and remains crucial to the stability of the system. And we've seen, a variety of episodes in different countries and across history where if that central bank independence gets significantly undermined, then it can lead to inflation. So it's definitely something that we're watching. Of course, something that has been mentioned many times is the FOMC includes 12 board members, and the Trump administration, after they appoint the next Fed chair, will have gained a majority in the board, but they still own only 4 or 5 members out of the 12 of the FOMC. So each voter gets one vote. So we still think the Federal Reserve has credibility. Ultimately, what markets will be watching is the Fed doing the right thing? And today, if you think about inflation that is above target, and as we discussed, the labor markets that are normalizing, then I think you definitely need a healthy debate at the Fed. So we're likely to have that next year, and we'll be monitoring that. And before we let you go, Pierre, your view on the credit markets is the relative calm that we're seeing in the credit markets, does that endure in 2026? And how does the AI issuance story tie into your views on the credit market at this point?
So the AI issuance story has made credit markets a little bit more exciting. You're absolutely right. It has been very calm, especially since April. So we saw kind of the hyperscaler issuance in November, a bit of indigestion within the credit markets, and we dipped our toes into some of those bond issuances because we thought there was value there. Aside from that, we're still highly selective within credit. We think that when credit markets get to when spreads get to these tight levels, they become a little bit more vulnerable to shocks. So we're a bit more conservative, highly selective in credit, and that'll likely continue as long as spreads stay at these levels.
Okay, highly selective in credit, maybe some opportunities at the long end of the Treasury curve. Pierre Chartres, M&G Investments, Fixed Income Investment Director. Some smart takes this morning. Thank you for your time, Pierre. Still ahead, we're going to get the latest as President Macron meets Xi Jinping at the start of his visit to China. But up next, we'll discuss the political consequences of President Putin's upcoming trip to India. That's coming up. This is Bloomberg. Welcome back to Horizons Middle East and Africa. Happy Thursday, everyone. I'm Tom Mackenzie in London. President Putin set to visit India for the first time since Russia's invasion of Ukraine. The rare trip underscoring the two nations' defence and energy ties. It comes as New Delhi also seeks to finalise a trade deal with Washington. Let's bring in our Russia government editor, Greg Sullivan, then. Greg, just underline for us how significant this relationship is between Russia and India and the history of that relationship.
Right. It's a very important relationship. And for India, it actually stretches back to Soviet times, the defense and economic ties. Politically, this trip will be a show of defiance for Vladimir Putin, who the West sought to isolate early in the invasion. Obviously, that hasn't worked. He's continued to travel to China, now India, and even to the U.S. for that Anchorage, Alaska summit. For Modi, it gives him a chance to demonstrate that he continues to chart a unique and independent foreign policy path for India. Economically, of course, they have deep energy and military ties. Russia is the biggest supplier of military equipment to India. Obviously, in the wake of the invasion of Ukraine, Indian oil purchases actually surged, which was vital for Russia. Of course, that prompted ire from Washington, which imposed tariffs on India and, of course, sanctioned Lukoil and Rosneft, complicating those purchases. But they're clearly going to be on the agenda when the two leaders meet.
And Greg, I guess the question is to what extent Modi can thread this needle between having a relationship with the US. We know the tensions are there, of course, given the purchases by India of Russian oil, and also having this deep and consequential relationship with Russia. How does he manage to balance the two?
Well, that will be the focus of this trip. It is clearly a balancing act for Modi. Both the U.S. and India have said that they are close to a trade deal, with India signaling that it could come as potentially as early as before the new year. Now, what the consequences of this trip are out of Washington remains to be seen. Trump has shown dissatisfaction with Indian purchases of Russian energy. Washington has long pushed back on Indian purchases of Russian defense equipment. Washington would clearly like to see India purchasing more defense equipment and energy from elsewhere, including them. So what the Trump reaction will be and whether that affects the trade deal at hand as India tries to get out from under those 50% tariffs, that will be a key question coming out of this two-day summit.
OK, Bloomberg's Russia government editor, Greg Sullivan, a great setup ahead of that summit. Thank you. Meanwhile, Presidents Emmanuel Macron and Xi Jinping are meeting in Beijing as the French leader begins a three-day trip to China. The pair will likely discuss a range of issues from trade to Taiwan. Let's get more then from our China correspondent, Min Min Lo. Min Min, how has the trip passed so far? What has stood out to you?
Yeah, I think the two men, they met this morning. It seemed like over an hour long, and they had a signing ceremony earlier this morning. They signed 12 cooperation agreements spanning areas like natural resources, aging, investment, and the like. And President Macron had a few things to say, right? A few of his key messages that stood out. One is he's calling for more cooperation when it comes to Ukraine, an end to attacks on critical infrastructure in Ukraine. He also talked about wanting to have more direct investments from China, and he said he's making progress on the exports of more agri-food exports from France. And I think you can tell a lot of what sort of deals or discussions are ongoing by looking at who is accompanying him on this trip, because you have the head of Airbus who is there, and we know President Xi also mentioned that there needs to be more consolidation of aviation development. Obviously, there is a Chinese leasing company that's looking to get more, planes from Airbus, but at the same time, China also trying to develop develop its own planes as well. And then you have the head of Danone, the food processing company, the head of Remy Cointreau, that is the cognac company, and that tells you that Macron is possibly still wanting to push China to back down on some of those probes right into French dairy and pork, and to also remove some of those remaining tariffs on French cognac, or the minimum price requirements that China has imposed, and that is all in retaliation to Europe's imposition of tariffs on Chinese EVs. And we know that France at the time had been instrumental in shaping that EU decision to impose tariffs on China.
And on the question of Taiwan, Min, is Xi Jinping likely to win his argument on this question and persuade Macron to pressure Japan and Takaichi to kind of walk back some of those statements? How does Taiwan fit into this meeting between the two leaders?
Yeah, I don't think he would get a big win on that front, but it is a platform for President to send his message because, again, he already said in that meeting he's calling for France to support China on that stance, calling for an equal international order here. And ahead of the meeting today, Wang Yi yesterday had met with his French counterpart in Beijing, calling for France's support on that front and telling them that, they should cooperate together to prevent Takaichi from stirring trouble in this region and repeating the mistakes of World War II. But if you recall, back in 2023, when Macron last came to China, he made some comments that seemed to suggest that France would limit its support on Taiwan, and that led to a lot of backlash in the U.S., right? He was among EU partners. He was talking about how, the EU shouldn't be involved in a conflict that has nothing to do with them at the time. So I think he's probably learned from that political backlash, and I don't think it is likely that he will make any comments to that extent this time, but he will probably continue to call for status quo.
OK, Min Lo, thank you very much indeed on the visit by President Macron, of course, to China. That continues. It's a 3-day visit. Let's bring you some redheads crossing the terminal right now. This is focused on the EU taking action against Meta. This is according to the Financial Times. The European Commission is, according to the Financial Times, planning a new antitrust investigation into Meta, parent company, of course, of Facebook and WhatsApp, over the rollout of artificial intelligence features within WhatsApp. Again, this is according to the Financial Times. The Commission was set to open the probe into how Meta integrated its Meta AI system within the popular messaging service earlier this year. That's a story we'll continue to monitor for you, of course, and as well, pre-market Meta will be in focus. Switching focus after the break, we're going to be talking about Scott Bessent and reports about potentially an additional role for the US Treasury Secretary. We'll bring you the details. That's coming up. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Tom McKenzie in London. Now, Bloomberg understands that Donald Trump's team is discussing the possibility of making Treasury Secretary Scott Bessent the top White House economic advisor. The new role of leading the National Economic Council would be in addition to his current job. Bloomberg's Jill Desus is with us. So, Jill, potentially an expansion of the power, the responsibility for the current US Treasury Secretary. What is the rationale? What would be the rationale behind giving Scott Bessent two key roles?
Well, look, Tom, I think, first of all, you're right that this would definitely be sort of an expansion of power, consolidation of power for Scott Bessent, giving him these key roles. The one thing that I would really point out is that in the Trump administration, particularly the second go-around, Trump 2.0, this isn't actually that unusual for a high-level official to actually hold multiple roles, wear multiple hats. I look at Secretary of State Marco Rubio, for example, who has quite a number of really prominent roles within the administration, including on the, sitting on the National Security Council, that kind of thing. When it comes to Scott Bessent, I think there's a couple of really key takeaways to take here when you're looking at what this would ultimately mean. First of all, the National Economic Council under the second Trump administration actually has a bit of a diminished role in terms of setting economic policy as maybe it did when Trump was first in office. But, it does have a pretty prominent role in kind of, espousing what the Trump administration's positions actually are. You really only have to look at Kevin Hassett and how much he's appearing on television, for example, to really kind of stress these policies. But I really think the critical thing here is that if this were to actually happen, it would give Scott Bessent an office in the West Wing. So, I mean, you're bringing him even closer to Trump's orbit in that kind of respect. So I think those kinds of immediate things really does indicate that Scott Bessent's influence within the White House appears to be growing.
Yeah, Jill, I love that you zeroed in to that fact, because that's what stood out to me as well, that the Treasury Secretary would have his own office in the White House, and that physical proximity to the president. And we know that that is important, having that regular FaceTime, of course, with President Trump. Meanwhile, Secretary Bessent as well is also pushing for a change in the rules when it comes to candidates then, Jill, for the role of regional Fed Reserve presidents. Why is this significant?
Yes, that's right, Tom. So essentially, he would want the selection to consider whether or not those regional Fed presidents have actually lived in the districts that they're presiding over for, I think, 3 years is what he was looking at. I think that what this tells us is it's part of some of the broader criticisms that we've really seen Scott Bessent zero in on when it comes to the Fed, particularly just this criticism that maybe they're drifting too much from that core mission of setting interest rate policies and sort of looking at some other things. So it kind of factors into some of these broader concerns that Bessent has had. I will just point out again that, when it comes to the Monetary Policy Committee and the roles of these regional Fed presidents, I mean, they can often have a pretty sizable influence. If you look at some of the regional Fed presidents now in, Cleveland, elsewhere, I mean, you're looking at some of the most hawkish, members of the Fed here. So I think really interesting to kind of zero in on the ways in which Bessent is advocating for some tweaks to the way that some of these people are actually selected.
OK. Bloomberg's Jill Desis, thank you very much indeed for that update. Some of the changes, possibly job changes for Scott Bessent, or at least an additional role, and his scrutiny of regional Fed presidents and their roles, of course. Let's check in briefly on the markets then. You do actually see yields up across US Treasuries and the dollar strengthening. US futures flat on the S&P E-minis. It was an interesting story yesterday across Wall Street because you had very modest gains being notched up for the S&P 500 and the Nasdaq, but it was the Russell 2000 that was really out of the gates with gains of almost 2%. Today, S&P E-minis, as I said, are flat. Here in Europe, European futures pointing to a decent session, up 0.6%. And certainly Fed rate cut expectations will be part of the narrative in Europe. You do, of course, have that Fed decision next week. Coming up, concerns about the US jobs market then driving those rate expectations in terms of bets on Fed cuts. We're going to talk it through with Martin Horne from Barings. That is next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Asian shares track Wall Street higher, with Japan outperforming as more evidence of a slowing US jobs market boosts the case for a Fed rate cut next week. With Russian President Vladimir Putin set to arrive in India, Prime Minister Modi facing a delicate balancing act between one of the country's most trusted partners and the United States. Plus, Bloomberg learns of discussions taking place for Treasury Secretary Scott Bessent to potentially lead the White House's National Economic Council should Kevin Hassett become the next Fed chair. It's just gone 9:30 a.m. across the Emirates, 5:30 a.m. here in the UK. I'm Tom McKenzie in London, in for Jemana Pasechi. Let's check in then on the markets. European stocks set for a fourth straight day of gains. Futures in Europe pointing higher by 0.5%. It was a really interesting session on Wall Street yesterday with very modest gains coming through for the S&P 500 and the Nasdaq, but it was the Russell 2000 that was storming up almost 2% by the close on those rate cut expectations. S&P E-minis currently flat, looking for direction. You have PCE data, of course, that preferred gauge for the Federal Reserve on inflation coming out tomorrow. Nasdaq 100 futures currently pointing lower by 25 points. Salesforce earnings for the current quarter, the forecast stronger than expected. European futures, as I said, pointing higher by 0.5. Let's flip the board and have a look cross asset. You did see a move into treasuries yesterday. Today, a little bit of selling pressure across the curve, not a huge amount, but between 1 to 2 basis points. The benchmark 10-year currently yielding 4.08, yields up 2 basis points. Euro dollar at 116, so it's dollar strength. Yields up is the story today. Currently down then, the single currency. As a result of that dollar strength, down by 0.1%, the euro. Brent at $63 a barrel, and copper at around record highs, above 11,500. Goldman Sachs, though, warning that it doesn't have much further to run because the fundamentals are not supporting the price action around copper. That, at least, is the view from the team at Goldman Sachs. Let's check in on how the markets in Asia are faring. Min Min Lo is in Hong Kong. Min Min.
Hey Tom, we are checking in on how the Japan bond markets are doing because there is the critical 30-year bond auction today that many investors are closely watching, and surprisingly, we saw very solid demand. In fact, bid to cover ratio was at the strongest level since 2019, and seems like the pickup in yields at about 3.4% or so, that was enough to entice investors to dip their toes back in and to snap up some of these longer end bonds, and dismissing some of the concerns around fiscal spending here. We are still seeing the shorter end, though, a little bit of a sell-off there. It seems to be still on that slow march towards 2% on the Japan 10-year, and certainly something to keep an eye on as we look towards that rate decision next week. But we are also watching the Chinese currency as well, because we are seeing this very slow, quiet resurgence of the yuan heading towards 7 per dollar. And you can see here, this chart shows you the spread between the PBOC fix, which is the midpoint of the day, versus economist consensus. And you can see here it's turned positive of late, and it's hit very high levels, the highest since 2022, 164 pips difference between the fix and the estimate. And this tells you that PBOC is trying to slow the rise of the yuan, right? And so because of part of the external factors, optimism around U.S.-China relations improving, and also the decline of the dollar because of the Fed rate cuts coming up.
OK, Min Min Lo in Hong Kong. Thank you with a check on the Asian markets. Now, there are growing concerns about the US labour market weakening after new data pointing to companies shedding payrolls in November by the most since early 2023. Swaps now pricing in, indicating rising expectations for a December cut, with traders signing more than a 90% chance of a 25 basis point reduction next week. Let's bring in Martin Horne, then co-head of global investments at Barings, for a take on this, but also the private markets as well. Martin, let's start on the macro and your views in terms of how the Fed adjusts, not just in December, but into 2026.
Yeah, Tom, clearly we're going to have another narrative where the Fed's trying to balance its target of 2% inflation, and that's a very difficult target to hit because structurally the global economy has changed now. And maybe we should be talking about whether that target is still relevant, with the need to balance its mandate and encourage growth in the US economy. And clearly, we're now seeing what we see at Barings, because we have kind of visibility on hundreds of companies out of the US, that we are in a very low, sluggish growth economy. We are seeing some, I would say, controlled fragility around things like the labour market, and it's definitely softened from this time last year. And that should allow the Fed to, in the short term, bring rates down. But I think really the outlook for 2026, even with the change of Fed chairman, should be a kind of measured approach to how they bring rates down gradually, because these inflationary conditions that are created by things like the development of AI and energy use, the controls of immigration, the onshoring, the impact that we're going to get greater transparency around all these trade tariffs, things like climate change and the impact on agricultural crops. All of these things are converging to create a world where pricing conditions aren't what they were 20 years ago. So, and they're going to continue to wrestle with that debate as we look into 2026.
So, Martin, as you talk about structurally higher inflation in the US and lackluster growth in 2026, I'm thinking stagflation. Is that where you'd go with this, or not quite as far?
Well, we really, the big question that answers that is going to be, what's the real impact of tariffs? So put yourself in the boardroom of most of those companies that are trading in the US right now. It was really, really difficult to make decisions on the competitive market, the demand curve in that market, and the pricing that you were going to place into that market for most of this year, because you didn't really know what the rules of the game were. You didn't know where you would be sourcing from. You didn't know the economic impact. And I think what we're going to see as we move into 26 is much more of a real repositioning of what that market looks like. And then we're going to see if it deteriorates this sort of economic position for the underlying businesses in a greater magnitude than is currently expected. At the moment, we're sort of thinking about a soft landing is still looks on. A soft landing in my head means plus 1%, minus 1%. These things you don't really care too much about. You could go into a slight technical recession, but it's not going to sort of change the dial on where we are in significant substance. I think more of this kind of limping along is the likely outlook for 2026. And certainly as I've been going around the region, this is seems to be accepted by a lot of the overseas investors that are looking at the US, and they are constantly trying to assess, I've got a structural overweight to the US market. What do I do as we move into 2026? Does that still look good to me?
Martin, what are you telling those clients then in terms of how they may hedge some of those risks and where the opportunities, where the value lies at this point?
Yeah, I think, Tom, to be honest with you, diversity of your options is a good response to a vacuum of uncertainty. So investors all the way through this year, as you know, because you've had them on your program, have been talking about the need to look at different options. What they found is it's really difficult to do that in size outside of the US because it still is the big capital market. It still is a readily available market where you can deploy capital of size and you sort of know what you're getting. But there are other options around the world. When you look at emerging market economies, for example, you're certainly seeing that those countries got inflation under control quicker. They've benefited from dollar devaluation, and they've got options monetarily, fiscally. They're still relatively tight. So if they need to stimulate their economy, they can. And if you think about Europe, maybe you feel good about some of the sort of defense spending and stimulus there. But Europe is a patchwork as ever, and it creates a cloud because of that patchwork. We're going to have, I think, ongoing government debt concerns over economies like France and the UK. And maybe that makes clients a bit more reticent about Europe being the kind of overseas diversification play, and maybe they're going to look elsewhere. Generally speaking, if you go along with the higher for longer thesis, if you believe that structurally the world is in a higher inflationary environment, income products will pay out. That gives you a contractual certainty. So if you're going to move away from the equity markets and look at sort of the bond allocations, income markets look good. I would be cautious about developed market government bonds, and I would be more bullish about what the corporate balance sheet looks like, because again, we've got visibility on that, and corporates to us look conservatively structured. Actually, governments and certain governments, certain developed market governments, those balance sheets look a little bit more wobbly, and so we'd make that delineation when you think about income products.
Okay, really interesting. The look at corporate balance sheets and the health there, relative health there versus some of the sovereigns. Martin Horne, co-head of Global Investments, with a take there on a cautionary note as we lead into 2026, of course, coming to us from Barings. Martin, thank you. Coming up, Tanzania's president. I'm going to switch focus. Tanzania's president accusing foreign powers of having a colonial mindset. We'll discuss the details next, what they've been saying. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Tom Mackenzie in London. Now, investor interest in Israel's financial markets has soared in 2025. Yes, it has soared this year. This even as the Gaza war and other brutal regional conflicts made headlines, of course, around the world. Bloomberg's editor-in-chief emeritus, Matt Winkler, has been examining this remarkable conundrum in his latest column. He joins us now from Tel Aviv. Matt, can you give us some examples? And this is a counterintuitive story to many of us who are not following the granularity of Israeli assets on a day-to-day basis. Talk us through what markets have been doing then in Israel.
Well, just about every market in Israel actually has been on the ascent. And actually, it goes back earlier than this year. It's been a trend really since actually the end of 2023, which is when we date, you could argue, the worst massacre since the Holocaust. And what is happening is this year, was a record for investment in Israel from people outside of Israel. $60 billion actually came into Israel this way, and at significantly higher valuations than we've seen in the past. The premium to buy assets in Israel by firms outside of Israel was greater than 50%, that premium. Another way of looking at it is exchange-traded funds. The biggest Israel exchange-traded fund outside of Israel had record inflows this year. And if you look at the shekel since 2023, it's up almost 30% since then. And if you look at the Israeli economy as a whole, measured by gross domestic product, it's actually outperforming by more than twice the average for all developed countries in the world. So this has been something as a trend, I said, in the making for quite some time, but if you like, it came to a climax in 2025. And if we're trying to figure out how is this possible, why did it happen? Actually, the answer is lots of things came together in 25 that made Israel a lot more secure than anyone would have imagined. Literally dealing with its foes, Hamas and Hezbollah, and then Iran in 2025. Iran especially, and if anyone wanted to know what's that really about, a lot of it has to do with artificial intelligence. Israel is one of the incubators of AI in the world. It's a hub. And if anyone wants to know how did Israel succeed as well as it did in its war with Iran earlier this year, the answer is AI technology. And so if the story of investment in the world today is, as we know, AI, Israel is where it's been happening for quite some time.
So that's essential to this. And it's really interesting that the data that you pull up there, Matt, in terms of overseas appetite for Israeli assets and the deal making, particularly when it comes to those Israeli firms trading in that premium. And so much of this is tied to tech expertise, cybersecurity, and AI, which is at the foundation of this relatively small and low population nation, and punching above its weight in terms of expertise on those fronts. And that is a key draw. Is the expectation, then, Matt, that continues?
You bet. You bet. And the reason why we know it continues is if you look at some of the biggest companies in the world, measured by their market capitalization, firms like Alphabet, Meta, they are investing in Israel at the same rapid pace that they started with, decades ago. So this is, as I said, a trend that has been in the making for quite some time. And Israel as a hub for technology is, going to be with us for some time.
Okay, Bloomberg's Editor-in-Chief Emeritus, Matt Winkler, thank you very much indeed. Worth checking out, of course, Matt's column on Bloomberg.com and, of course, on The Terminal. Let's switch focus now. Tanzania's President Samia Suluhu Hassan has accused foreign powers of having a colonial attitude after condemnation of deadly violence during October's election. The United Nations has called for an investigation, saying hundreds of people may have been killed by security forces firing on protesters. For more, let's bring in Bloomberg's Ondiro Oganga, who joins us now from Kigali, Rwanda. Ondiro, what more do we know then? The United Nations has condemned the crackdown on these protests, and that is a grouping, of course, that involves countries that do not have that colonial past.
Good morning, Tom. So what we saw, particularly from that address from the president, is what she chose to do is deflect and deny. Instead of focusing on what happened in the country pre-elections, during election and post, which led to mass bloodshed, she chose instead to shift the goalposts. And we saw her pointing the finger of blame, particularly to Western countries. And she went as far as asking, who are you? Do you think we still live in the pre-colonial and colonial era where you tell us jump and we ask how high? And she said that she's not going to be intimidated by anyone, particularly now that international pressure is mounting for her to release opposition leader Tundu Lissu, who's been sitting in prison since April on charges of treason. And while she acknowledged that there were protests and there was skirmishes in the country, she fell short of acknowledging the brute force that we saw coming from the government. Instead, she chose to justify what the police did, saying that the government was just not going to sit back and watch some of these protesters vandalize and ruin property and ruin the peace that they've worked so hard to build as a country. And she even went as far as warning that for the protests that are planned on the 9th of December, the government will be ready. And to your point, talking about the United Nations, pressure is beginning to mount and it's coming fast and furious. Outside of the UN saying that they'd like an investigation on what happened, we've also seen calls from ICC to investigate those crimes against humanity. We're also seeing US senators question the legality and validity of these elections, with the European Parliament saying they would like to block aid to Tanzania.
Well, is that international pressure likely to have an impact then on Dero?
It already has, because by the time she's coming out to speak about it, to an extent, she knows what is coming, and she knows that they'll likely feel the pain and the pinch that is coming in the few months or few years ahead. During her swearing-in speech, she almost foreshadowed it, and she said she almost reduced what had happened and called it a stain, and said that was going to affect their efforts to raise financing in the international market, and said the government will now have to rely on the domestic markets. Tanzania was planning to raise about $3.6 billion from the external markets and about $2 billion from the domestic market. But now things are about to change and they'll have to heavily rely on the domestic market. The problem with that is we can look at Uganda as a case study. When Uganda was blocked from the international market, they had to heavily borrow from their domestic market. And this comes with its own risk. You expose your currency to a lot of FX pressures. You're crowding out the private sector from borrowing in the markets. And also there are no checks and balances. Who's to say that every dollar or every shilling that you've borrowed will be invested wisely? The mega infrastructure projects could also feel as a pressure from this. And if this impasse continues, tourism will likely suffer.
OK, Bloomberg's Ondira Ogunga in Kigali, Rwanda. Thank you for that update, with a focus, of course, on Tanzania and the political pressure, international pressure now, on the leadership of that nation. Coming up, shipping rates to transport commodities around the world surge. We're going to discuss the factors driving that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Tom McKenzie in London. Now, rates to ship commodities across the world's oceans are heading for a rare year-end surge. Typically, freight costs dip at the end of the year due to seasonal weakness in demand. That's not what's happening right now. For more on what is causing this, let's bring in Andrew Janes in Singapore, who leads our energy and commodities coverage in Asia. Andrew, this is just a great piece of Bloomberg reporting, pulling out the stats and data that Bloomberg has to show this story, which is, again, counter consensus. It's unusual. We don't usually see this. What is driving these big jumps in freight rates at this point?
Hi, Tom. Well, it's three big factors, really: sanctions, war, and rising supply. The sanctions are probably the biggest driver, and they're a particularly big factor for the oil market. We've seen the US put sanctions on Russia's two big oil producers, and that's, interestingly, in India and China, who have been the two biggest buyers of Russian oil. That's actually spurred quite a big change in behaviour, particularly in India, where most refiners are now avoiding Russian oil, and that causes a lot of disruption in the shipping market. I mean, cargoes that were already on their way to India might have had to turn back. Then they've got to, in a hurry, arrange alternate supplies, try and get new ships. I mean, we recently had a story about oil travelling from Guyana at the top of South America all the way to India, which sort of shows the extent they're going to avoid sanctions risk. One of the other big things, of course, is war. This is more an ongoing factor. A lot of ship owners have been avoiding the Red Sea, the Suez Canal and the Red Sea, due to the risk of Houthi attacks. That's continuing to happen, and that's meaning they have to travel a lot farther around the southern tip of Africa. And then we have supply. I mean, OPEC Plus has spent most of the year pumping more oil. Also in the Americas, the US, Brazil, Guyana, they're pumping a lot more. In gas, there's been some big new LNG export projects coming on stream in the US, and a lot of that's going across to Europe, replacing what they would have got from Russia before the war in Ukraine. And even in things like iron ore, despite the economic slowdown in China, they've still been importing a lot of it. Steel mills haven't really reduced activity rates too much, and instead they're turning more to export markets now.
Yeah. Andrew, how does this set us up for next year? I'm anxious about inflation. I'm anxious about what it means for pricing. I mean, the ship brokers are probably making hay on this, and the ship company owners as well. How does this continue into next year, Andrew?
Yeah, I think prices are going to stay high. They may come down a bit. There's a few factors that could spur big drops. One of those would be if people suddenly decided that sending stuff through the Suez Canal and the Red Sea was safe again. We have a truce between Israel and Hamas, but it looks pretty fragile, so it's hard to sort of see a big return to people sending goods through there. If there was a meaningful ceasefire in Russia and Ukraine and a rollback of sanctions, that would also lead to a big drop in prices. So really dependent on geopolitical events.
Andrew, we're out of time. We appreciate that, the insights, of course. Andrew James in Singapore, who leads our energy coverage. The Brief is next. Daybreak is next. This is Bloomberg.